Thank you, Danielle. I really thank you and NinjaTrader for having me here today. Just want to say that getting on the NinjaTrader platform, it's really a great investment. It's a terrific platform. It really is really versatile, and that's why our program is only configured on the NinjaTrader platform. And just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago. And I've been involved in the optimization of software systems for the last 10 years via mathematical modeling. And essentially, what I've done is looked upon trading, or looked upon the stock market, futures market, forex markets, essentially as a series of independent variables, and put trading into a and configured trading into what is essentially a multivariable equation, in which the solution of is a successful trade. So what are the variables that we look at and we optimize in order to get a trading entry with a high degree of specificity and also a high degree of sensitivity, i.e. A trading entry that has a really, really high positive predictive value. Now, and positive predictive value is sensitivity over specificity times prevalence. And I don't want to overwhelm you with this because ultimately it isn't that important. But here's how I want you to look at trading the markets, whether you day trade, whether you swing trade, or even if you long-term trade. You want to take a trade that is very sensitive. Now, sensitivity is defined as true positive over false negative. If you trade with a great degree of sensitivity, you are going to get into every true positive market move. And the problem with trading with a great amount of sensitivity is that you're going to get sucked into false positive moves. And trading is all about the number of losers you take, not about the number of winners you take. So what we do at Rightline is we try to trade with a great amount of specificity. We are not so much interested in finding the true positives. We're looking at finding the true negatives. We do not want to get into a false positive move. We want to filter the trades so that the positive predictive value of the trades that we get into are extremely high, i.e. we have a winning percentage of 80% or greater. Now, positive predictive value is essentially the result of this multivariable equation, and we need to define all of the parameters that are important when we trade and have to look at them and determine their optimal values. Now, the only other variable that goes into that is prevalence. And I'll talk a little bit more about prevalence later, but I just really want you to look at the fact that what we're really doing is we're trying to solve a multivariable equation. Now, ultimately, the equation may have so many independent variables that it may be near impossible to solve. I mean, if you gave this problem to a computer to determine all the independent variables, it may take almost forever to optimize it. Just like a hyperbola asymptotes towards infinity as it approaches the y-axis. You try to get as close a positive predictive value as you can to 100%, but you're never going to get there. So what we've done is looked into every single independent variable that we could find and optimize them each individually in order to develop a software system that gives you entries with a very, very high winning percentage. Now, in order to do that, you have to have the market mindset of understanding that if you're going to trade with a lot of specificity, there are going to be winning moves that get by you. But what's important is when you're in a move, it makes money for you. And that's really the key. The day traders and swing traders that want to get into every single move and cannot take it when a 25-tick move goes by them, but they simply cannot get into it, are going to wind up overtrading, and they're going to wind up busting their accounts. The ones that don't mind losing some good moves, but are only interested in taking the true positive moves, and what they really want to do is stay out of the false positive moves, are the ones that are the ones that are going to get to their goal. Now, in order to do so, we have to come up with a mathematical philosophy. Now, the philosophy is in essence, what are the most important independent variables? Is price action an important independent variable? Does price action alone gives you the sensitivity, specificity, and positive predictive value high enough to trigger a buy-sell recommendation that's going to make you profitable? Now, our feeling is that is not the case. Price action is extremely important, and really, as far as I'm concerned, as an independent variable, it's one of the most important. I mean, look to optimize price action with tremendously aggressively, but it isn't enough alone. You cannot trade without indicators. Now, is indicator analysis enough? Is there some unique composition of indicator signals, some confluence of indicator signals that will trigger a buy-sell recommendation with the sensitivity, specificity, and positive predictive value that you need to get a successful trading entry? The answer to that is no as well. Now, and then there's a further subdivision of those that trade both price action and indicator analysis, and that is looking at one time frame as an independent variable enough, or must you use multiple higher time frames to confirm the validity of your trading entry? So here we have three independent variables, and what we have found is that all three are important, but each of them need to be optimized. Price action is extremely important. Indicator analysis is important to confirm your entry based on price action, and you must only trade in the direction of the multiple time frames as they come out via the use of fractal analysis or multiple higher time frames. So all of these are essential independent variables, but they have to be triaged and optimized individually. Now, I've seen a lot of people advocate, say how indicators just don't work, they don't add anything, they're not forward-looking, but that's just not the case. And I'm going to show you indicators that we have developed that are forward-looking and that they increase the positive predictive value of your trade remarkably. So don't believe the naysayers. Indicator analysis is essential. Price action, again, extremely important, and you must respect multiple higher time frame trends. So basically, I went into this slide already. Price action does not provide you with a high enough predictive value, neither does any confluence of indicator signals. Now, if either above were true, the financial markets could be robot traded for millions in profits. If there's any holy grail of indicator confluence signals that gave you a blue dot long that almost always worked, or a red dot short that almost always worked, it would make the market incredibly easy to trade. And as we all know, it is not simple. So the goal of right line trading is to combine all these independent variables, market structure, indicator analysis, fractal analysis, into a simple trading platform that has been optimized mathematically to provide you with remarkably accurate trading entries. And by remarkably accurate, I mean precise trading entries. And by precise, I mean mathematically those with a very high positive predictive value. Now, first of all, as part of this, we don't trade or call tops or bottoms. I've never seen any software that can call a top or a bottom. If you want to use the oscillator to call oscillator divergence, or the MACD to call MACD divergence, it will do so, but you're going to get run over so often that the positive predictive value of trading market structure and indicator confluences to try to call a top or a bottom is not high enough. We do not trade reversals. We do not counter trend trade. We believe that the institutional traders determine the trend, and we want to trade with the big money. And since the big money creates the trend, we want to be in with them on the trade, not counter trend against them on the trade. And you're going to see when we go to the platform how counter trend traders just get crushed. They get run over time and time again. You want to trade with the trend. And again, we don't try and predict breakouts. Now, we do have a couple of entries that are sort of breakout-ish, but they're always in the direction of the trend. And you're going to see that they're not the anticipatory breakout trading that some software systems try to do. If you try to trade breakouts, you're going to get into some really big moves, but you're going to get stopped out quite a bit. As you try to get into as many breakouts as possible, i.e. increase sensitivity, you're going to lose your specificity. You're going to get in on a lot of moves that as soon as you get into them, they just reverse on you and run you over. So we are trend traders only. Now, here's price action, and it determines market structure. And you can see that it provides you with some useful information. You can see how right here, this you give a move up, you have a retracement. It's 100% retracement. If we want to look at this as an Elliott wave move, I do not believe in Fibonacci. And in fact, I find Fibonacci to be, and I know this may go against a lot of things that you've heard, what a lot of people have taught you or base their trading style on. I've studied Fibonacci extensively. I know the mathematics of it. Fibonacci transformations are very, they're very interesting transformations, and they do describe some interesting natural phenomenon. But they're a useless transformation, and above and beyond describing the number of tips in a snowflake, or the number of or the way that a pine cone distributes its little bumps, it doesn't really describe anything in physical nature of any importance. And when Fibonacci developed it, I think the poor guy would turn over in his grave if he ever thought that it was used to try to determine the direction of the stock market. And the fact is, we looked at Fibonacci and the positive predictive value of using Fibonacci levels in determining whether or not a price was going to respect a fib level. And they do sometimes, and they don't a lot. So if you use Fibonacci to try to increase the precision of your trading, it won't. As often as it helps you, it's going to get in your way. and as often as you try to use it as an area of support and resistance, it's going to fail. So we do not trade with Fibonacci, and I strongly recommend that nobody use it because it just is not an effective tool and has never been shown in any mathematical or scientific analysis to have any validity whatsoever in determining market direction. The same so with Elliott wave. Although I've looked at Elliott wave extensively too, and found that there's a little more validity in Elliott wave. We don't trade Elliott wave, and that's why we don't trade reversals. But if you look at this move, you have a move up, you have 100% retracement, and then you have the move up, and this is a bullish engulfing candle. And the bullish engulfing candle tells you, I really do like candlestick formations. And the bullish engulfing candle tells you that bulls are in firm control coming off this pivot low. And the market goes up. And it happens the same thing here. You get a move down, whoops, and a move back up. There's a complete swing. Now you're at a pivot high, and it heads down on a bearish engulfing candle. And the market comes down, makes a one candle move up, and then heads all the way back to the bottom. So there is validity in candlestick formations, market structure, and pivots, areas of support and resistance. But it's not enough to get you where you want to be. So we further define market structure as priced above the 50-period simple moving average. This is where we go long only. Below, this is where we go short only. We believe the bulls are in control above the 50 and the bears are in control below the 50. If we try to go long below the 50, we're counter trend trading. If we try to go short above the 50, we're counter trend trading. Now you'll notice that a big move up off the bottom is a move that we can't take. What we're doing here is we're increasing specificity and decreasing sensitivity. You may get a very, very nice move off the bottom, but we can't go long below the 50, and because we don't call reversals, and the trend off the bottom is a downtrend, we can't take a long trade, also because we're counter trend trading, and that's against our rules. Now we also use a 15-period proprietary moving average. We want to go short when we're below the 15 and below the 50, long when we're above the 15 and above the 50. That's why we have these two moving averages, red and green. And the reason I'm moving quickly is I really want to get to the platform. And then we add pivots. We only use the major swing pivots, not the intermediary pivots. And when the market turns here, it means that all these buyers ran into a whole lot of sellers at this area before, and they ran into a whole lot of sellers here again. So where there was a major swing turn in the market previously is where there's likely to be a major swing turn in the market again. Here again, we're adding specificity to our trading. We're respecting the fact that the pivot's going to hold. Now, every time a pivot is hit, it gets weaker and weaker. And if a pivot's been hit 3 or 4 times, it may break. But we've looked at trading without pivots and with pivots over a year on market replay. And what we found is that the equity curve, or the number of true positive moves, entries where we make money, increases remarkably if we respect the major swing pivots. So we always do, almost always do. Remember trading is 10 to 15% discretionary, and you see a pivot that's been hit multiple times, you can take a trade. Remember, what the goal of the platform to do is to define risk. And then based on your risk tolerance, you're going to have to make a little bit of a decision in every trade, and that's that 10%. And what we're looking for are those trades that are just so great, that have so much going for them, that the positive predictive value approaches 85 to 90%, and you don't even have to think twice. You're just in the trade. Now, we also determined that the distance that you take the trade off of support or resistance is a major independent variable in determining whether or not you're going to get a successful trade. So we created a indicator, and this 7 tells you that the candle body open is 7 ticks off support. So you want to be 4 ticks or less off support, or for a long, and 4 ticks or less off resistance for a short. Here, what we're doing is we're defining those independent variables. One of them is the distance off support or resistance, and we're creating a platform that defines these independent variables for you and makes an assessment of them. Remember, if you trade way off of support, you always have the problem of after you get into the trade then retraces right back into support, stops you out, and then continues up. So you want to stay tight to support or resistance. Then we looked at 3 of the very commonly used indicators. Now, order flow is relatively new, and it's the number of executed buys or executed sells that take place at any given level. And for us, it's at any given tick level. Stochastic is very, very commonly used, and momentum is a very important indicator. It's a MACD. Now, I just want to mention stochastic very briefly. Stochastic on a long move measures, 3 parameters are required for stochastic to work. You need the high of a candle, the low of a candle, and on a long trade, you need the open, the close, and the high for a long, and the open and close, and the low on a move to the downside. And as that high moves further and further away from the candle open, stochastic rises. And when the low moves further and further down off the candle open, you have the stochastic move further and further to the downside. Now, people have been using stochastic to call overbought, oversold markets for a long, long time. But has anybody evaluated mathematically the predictive value of using stochastic and whether or not it enhances the positive predictive value of a trade? And we did. And we analyzed the stochastic entry. We analyzed success with stochastic in the multivariable equation and with stochastic out. And what we found is that it has absolutely no predictive value. Now, so stochastic is in the middle of our 3-line indicator, and it's still there. But we've reformatted the platform, so you'll see it doesn't get in our way. But what we have found is stochastic to be useless, and it makes a lot of sense if you look at it this way. If you divide traders in half, everyone trades stochastic a little bit differently. There's a group of traders that when the stochastic is overbought, believe that bulls are in control, and as the market continues to break pivots to the upside, you continue to buy. You buy when bulls are firmly in control. There's another group of traders that when the market is overbought, look for stochastic divergence and the opportunity to take the market short. So who's right? And it's the only indicator where people have to make a decision as to how to use it. Use stochastic to continue to go long and to continue to go short an overbought, oversold market, or look at it as a way of trading a reversal. No other indicator is like that. And it turns out that everybody is wrong, everyone's right. But stochastic does nothing to enhance the predictive value of a trade. And the problem that we all face in this market, and we all face as day traders, is that too many people look at day trading as an art. They put together a platform and and base what is required and base their trading entries on assumptions. Gee, this looks like it should work, therefore it works. They don't mathematically backtest the platform and come up with an actual sensitivity, specificity, and positive predictive value. And that's what's key. And I've been in many webinars and asked the developers, what is the sensitivity and specificity of your trading entries? And no one can tell me. And if a developer cannot tell you that, then the platform as a trading tool is worthless. It's like getting a medicine, but the doctor who administers it cannot tell you how often it's successful and how often it provides you with an allergic reaction that's going to cause you to keel over and die. The point is, these are parameters you must know, or you cannot tell anybody that the software is successful. Now, we know that by looking at multi-time frame order flow and looking at multi-time frame momentum to confirm the validity of an entry based on market structure increases the predictive value of a trade. So we developed the 3-line indicator. Now, the first line is order flow. When it's red, we have order flow going down, a predominance of sellers over buyers on multiple time frames. Line 3 is momentum. It's simply a MACD with the signal line accelerating away from the slow line. And when momentum is down on multiple time frames, the 3rd line is red. Now, there's also blue, where long term is up, short term is down, but you don't even have to worry. In fact, we don't even project the 3-line anymore. We removed it. What we did is project the results of the 3-line on the candles themselves to simplify trading and to really make the platform itself intuitive and not have you have to wonder whether you have all 3 lines in sync. You're going to see that all really, really easily. Now, let's take a look. This is a really more primitive version of our software system at a long trade. You see the 3 lines green, and it tells you that with the candle, and I think this one's better, outlined in blue. That blue outline occurs intra-bar. Our modified 15 is up, our 50 is up. We know we're trading with the trend. You're in 1 tick above the close of the candle, and up you go. Same thing to the downside. You've got yellow projected around the candle. You know all 3 lines are red. And remember, that middle line, we don't care, actually. But you have all 3 lines, and you see it in the candles. You don't have to look down. You're in on a break of the 50 to the downside, trading with the trend 50 and 15 down. Here's a break of the 15, not the 50. All 3 lines on the 3-line indicator are down. Another break to the upside. All 3 lines of the 3-line are green. Now, this is a market structure signal. We have a downtrend forming. Now, the A, B, and C here are not put in by me. They're put in by the software. Any 2 candles of the same color that occur in continuity confirm a downtrend, and you get an A print. Then you wait for, now I choose to color my B candles, which is the counter trend candle in magenta. Now these are all people going long. Now they're going long in a developing short move, so they're counter trend trading. So what we do is wait for the 50 and the 15 to roll, the C candle. The C begins to flash when there's a chance for the B candle to be engulfed, to show that sellers have come back into the market with a vengeance. And as soon as the C prints, you're already in once you see the C start to flash. You're in 1 tick below the close. This is a range bar. You know where the close is going to be already. If the C candle matures, your entry is hit, it's then propelled down by two forces. The addition of sellers and all the traders who were stopped out in that big candle who were long. And this is the candle we don't want to be in ever. We don't want to be in the counter trend candle. And there are always counter trend traders giving us big candles to exploit. Here's another one. 50 and 15 are down. Counter trend move. A group of traders have decided this market's fallen enough and I don't want it to fall anymore. So we're going to have the C candle engulf them. Now at this point, I could go on, but I want to go to the platform because I am running out of time. I only have 10 more minutes, and I want to go over and just show you two, I think they're remarkable additions that we've made. One of them is unique to Rightline, and you will not see it anyplace else. Okay, now this is our bonds. Bonds is a very, very difficult market to trade, but it's worth $32 a tick. If you can get a 7 or 8 tick move, you have a $500 or $600 trade. But there really is no trading room that I've seen that trades bonds and notes. So what we've done in order to increase precision, increase the predictive value of a trade, and give you a better shot at getting a winner and allow you to trade very, very difficult instruments, is these two lines. And what we did is we looked at markets that correlate with a correlation coefficient of 70% or greater with either the same direction of bonds or in the reverse direction as bonds, 70% or more of the time. And we found so many markets that do, we had to create two lines. And this is called quantitative market analysis, or the quantitative analysis of correlative markets. So in these two lines are multiple markets that either move on a down trade with bonds or they move in a counter trend direction. When you get both of these lines red and you're looking at a short trade, which is right here, the move to the downside, the retracement into resistance, and the continuation trade to the downside. With these two lines red, you're looking at an extremely powerful and very successful trade. These are very close to 90%, have a positive predictive value close to 90%. Here's that C I was telling you about. You get the move down. The B candle comes. They're your counter trend people. The market's firmly to the downside, and the C candle engulfs B, and this is a very lucrative trade. If our third target here is 10 ticks. If you can get 10 ticks on bonds on one trade, you have $650 based on our very, very conservative ATM strategy. Now, in order to make the predictive value of the trade even greater, what we did was, remember I said that it's really important to look at multiple higher time frames? Well, our software does it for you. These background colors define the direction of the 50, the 15, support and resistance on multiple higher time frames. Essentially, you don't have to look at the higher time frames. This background color is doing all the assessing for you. And what I really like are indicators that work and function but are not affected by any price action on the trading chart. These are affected by price action on two higher time frames. And you can see this is our most powerful down color. And during this time, price falls, but it's not this price dropping that turns this pink. It's the long-term time frames going down that are and the shorter-term time frame that we're looking at simply falls. And you can see this is a different color. Hold on. You know what I have to do? I have to refresh. Hold on one second. Here we go. You can see when we get that strongest down color, there's the move to the downside. There's the retracement right there. There's a huge bond trade. The reason I pick bonds, I could pick any instrument I want. Principles are all the same. Here's the strongest up color, the dark green. All we need to do is get a signal with the best color. And this is why if you trade with specificity, you have to trade with patience, because the alignment of all of these parameters takes time. And there's your perfect log entry. Right off the support, and you see the candles surrounded by order flow. Tells you have order flow and momentum. The quant lines are dual green. The chance of this retracement and move up, this continuation trade to the upside, failing are very, very, very low. All these correlative markets are moving to the upside. The higher time frames are moving to the upside. And what this dark green tells you is that there's no overhead resistance, and the 50 and the 50 are moving to the upside. That's a lot of information to project onto your trading chart. And then most recently, we added another indicator, which is market profile. We found that market profile is extremely important. And you can see the histogram on the left. We don't really use the histogram very much, but we really respect the value area high, value area low, and the point of control as areas of support and resistance. And I'll tell you, price really respects these areas. It wants to stay within the value area high, value area low, and it respects that point of control as an area of support and resistance. So we've thrown as many independent variables into the equation that we can to allow us to trade with as much precision as possible. Today we had 3 trades and we had 3 winners. And that's what our goal is. There were trades that got by us, but I'll show you the trade I took today on bonds. The trades we take are successful. Now I took this short here on only one quant line. Now, the reasons why I was able to trade a yellow 15, it's a little more complex a rule. I didn't take the C. I should have taken this retracement, and the second win would have taken me out. And that would have been the end. But you can see, basically, I'm conforming to all our rules. The background bias is pink. I know that we're down on multiple higher time frames. We're in a confirmed downtrend. Both of these candles are outlined, knowing that order flow and momentum are in my direction. And what makes this trade really nice is we're trading right off the point of control. We break it and retrace right back into the point of control. That's what's so great about the trade. The other 2 trades, I had a 12-tick winner on crude oil. And let me just show you really briefly crude. Now, we have quant lines for many, many markets. And ultimately, what we're going to do is we're going to create a dashboard. And when the quant lines align on a given market, you're going to get an audible and visual alert. So that we're going to create quant lines for copper, for palladium, for soybeans, wheat, and corn. And the quant lines are so effective in helping us trade. There are notes. We also trade treasury notes. They are very tough to trade, but people don't stay away from them because they stay away from them because they're choppy and they're difficult to trade. But with the quant lines, market profile, and our background bias, we trade them very successfully. And at $32 a tick, you better trade with precision, because if you lose a trade, you're in the doghouse. But if you get a successful trade, you really make a ton of money. And look at this trade right here, this C candle. Here's our quant. We only need one quant line on crude because we have fewer correlative markets in crude. We have a break to the downside, a retracement almost into the value area low, and a move to the downside. Background bias is pink. This is a C candle. These are the unfortunate traders in the counter trend candle. They're not going anywhere. Same thing here. You get the B, the C candle, 15's down, 50's down, and man, look at, you get this move from here all the way to here. That's a huge move. You simply have to have patience. Here's another one, right here. Here's another trade right here. And what we look for is consolidation right into resistance, and then the move down. So that's really it. I mean, there's a lot going on the chart, but it's very, very intuitive and really very easy to trade. And if you pay attention, I trade 4 markets in the room in the morning, and let me tell you, sometimes I miss a trade, but if you pay attention, you're going to get almost every major move. And if you wait for all of the variables to align, you're going to be able to get a trading entry with an exceedingly high predictive value. And that's really the name of the game. You're going to have moves that go past you where all of these variables don't line up, but you know what? You just can't care because they are not important. So are there any questions? I only have about 2 minutes for questions. Are there any questions I can answer? Hold on, let me just take a look. Yeah, we only use 1 day for market profile, and the reason is we are not really market profile traders. What we're looking for is to use market profile as areas of support and resistance, areas to trade off of, but we don't look for nodes and the more complex formations that market profile can give us. We use market profile as simply another independent variable that we can optimize to give us a successful trading entry, and that really comes from a daily market profile. No, what we do is the software package is $39.99 for life. You can also lease it if you go to our order page. And if you go to www. Leo, can you put the order page in? Okay, and you can see we have multiple leasing options that are inexpensive, and we insert, if you want the lifetime package. It comes with all the quant lines. Now, the one thing that we always do, if we get an upgrade in the system, like all the people who bought the software, when we created the quant lines, we gave them to them for free. As we create additional markets for the quant lines, we'll give them the additional markets. We took our market profile is incredibly accurate, and we looked at many market profiles out there. A lot of them are not accurate. They don't calculate. The point of control is easy, but not the value area high or value area low. Ours works incredibly well. We just gave it out. So you can lease the software. We also have a whole execution platform that I just don't have time to show you, but you can either lease or own the software, and you can come into the trading room and trade with me or over my shoulder. So that's really it. I really don't want to overstay my time. We're heading into July 4th, and I know it's a holiday. I want to thank Danielle and NinjaTrader for giving me the opportunity to talk to you. I'll be in the office here for at least another 45 minutes. You're welcome to call me. Our phone number is 1-855-765-6681, but it's on our website. We do great tech support. We make sure everything is functioning and working great on your computer, and that's really about it. Please elaborate on the fair value area on the chart. Well, by fair value, I assume you mean between the value area high and the value area low. You know, I can't. Let me tell you why I can't answer. We're just running out of time. I apologize to you. Um, the auto traders are out there. What we're doing, Chris, is we are in the process of integrating the quant lines and market profile into the autos to give them more precision and give them a better predictive value. It's taking a little bit of time, but we simply are going to relaunch the autos with the addition of these two indicators, and so they're going to take fewer trades, but a greater percentage of winners. We invested a huge amount of time into the autos. We're simply working right now on them to, they should be ready within a week to a week and a half. So we really want to make those auto traders better. So listen, I really do have to go. I really don't want to run over time. I'll be here in the office. If you want to call me, if you go to our website, there's a contact us page. You can email me, send me any questions. I'll be happy. And just remember this, we have a free trial to the trading room. There's a link on our website for free trial. You're all welcome to come in, see how I trade, see how the software functions. You don't have to buy anything until you kick the tires on the car. Now, if you ask for a free trial, we're not going to bring you into the room till Monday. We did great today. I anticipate we'll do great tomorrow, but tomorrow's going to be very low volume. So let's start the post-holiday week and bring you in on Monday. So you will get notification that we got your email, and your username and password will start on Monday. So listen, everyone, I got to go. Danielle, thank you so much. Thank you so much, NinjaTrader. And listen, no matter what you do, no matter what software package you trade, whatever your style, I really wish you the best of luck. I want you guys, along with me and our traders, to make the money. There's lots of commercial traders out there. Why don't we take the money home and not them? So thank you so much, and I'm going to log off, turn it back over to Danielle, and just thank her once.